All right. Hello, everybody, and welcome to another Pepperstone live event here on YouTube. I'm very excited today to be bringing you one of my favorite topics, which is, of course, talking about big bank liquidity and
All
learning
right.
to
Hello,
scalp,
everybody,
the
and
best two
welcome.
combos in the world. Hey, Ty. So, we're about to get ready. But, Tyrone, are you excited for today's session?
I'm very excited about today's session, but not as excited as you should be because it's Thomas's birthday today. So he's taking time away from his, what are you, 30? From
A little
his
bit older on
birthday.
that one.
And yeah, so a big happy birthday to Thomas. And I know the whole community has wished him a really good day. So thank you for joining us. But yeah, we're really looking forward to tonight. It is Thomas's favorite subject. Because it was his birthday, we gave him his favorite subject. So yeah,
Yep.
look out for a really, really good webinar.
Yeah, I'm genuinely excited about talking about these things. Even on my birthday, Ty, we're always here for everybody. So, of course, what we'll be going through today is realistically a few topics, and it's going to be a bit of a whirlwind. But I hope that you understand by the end of today's session, we'll be understanding a little bit better why supply and demand are great concepts for scalping, whether you're a forex trader, a commodities trader, or of course a stock or index trader. Then we'll be looking at why normal ways of trading supply demand kind of is wrong in some ways for scalping and day trading, and why we need to be more reactive than anything else. And then we'll be talking about finding out where the big banks place their orders, how we can see that, and of course some positions or scalping concepts that we can use around these methods. Of course, we do have Q&A, so if you have questions throughout today's session, feel free to put them in the comments. We're in the chat room right now. So you'll be able to, of course, ask those, and we're more than happy to answer them throughout, or we'll park them till the end and answer them as well. So feel free to smash that like button and, of course, put it in the comments. All right, without further ado, let's begin with the topic of today. And I'm going to get rid of our heads for a minute so everyone can see these slides. So in essence, basically markets, sometimes you can call them different things. And what that means is we sometimes have people saying the word accumulation. Accumulation could also become a demand zone if we get a breakout. This is something we'll learn about today. So we need to know that there's all these fancy terms for things. Let's just break it down to what it is. Effectively, a range like this, which can also be known as a channel, is an area where effectively the orders have been placed. Once we see a breakout in a certain direction, that's telling us that the orders that were placed here, the power is in the bullish direction, and therefore it becomes what we call a demand zone. It means demand is greater than supply. Okay, that's something we'll be talking about later on today. Now, many of you will know the word distribution, or again, another channel up here. So the market goes up and it becomes what we call a supply zone when it breaks down below. And then, of course, markets will do this. Now, markets tend to move in this direction because they need to relax, they need to chill. And the reason why they need to chill is because they need to reset the indicators. Now, how many of you have gotten into trading, and what you've first thought about is, of course, we're going to use stochastic, we're going to use MACD, we're going to use everything like that. We're going to learn price action, we're going to understand these concepts. And then you go overbought, oversold, and that's how you usually apply it. We all start in a place like that. Most people do. But what you'll be understanding today is that actually what happens is when you go into potentially an overbought and you go into these zones, effectively the market will need to take a breather before it can make the next move. It needs to reset those indicators, doesn't it, Tyrone?
It certainly does, and I knew that Thomas's favourite man would be making an appearance at some point tonight.
He's coming.
But there is a very good reason for it, because look, I know we seem to bring it up a lot, but I think people who have actually been in the community and who've been doing the advanced scalping course really attest to how powerful this method is. So it's going to seem a lot, but it does get actually easier when you do start to understand it. But 100% correct, indicators have to reset. And yeah, through that distribution and accumulation phases, these sorts of things are happening. So it's very important to actually understand that that is actually what's happening in these zones.
A few people saying does this get recorded? Yes, it does. And thank you for the birthday wishes here, and welcome everyone that's coming through. So Tyrone, successful tape reading, as we know with Wyckoff, he says, it's the study of force. It requires our ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. I want to know where the big players are at. We always want to know that. It's just, but we have to know where the big players are at. Contrary to popular belief, it's important that we're actually going with them and not against them. That's why if you ever load up a sentiment indicator, and I encourage people to have a look at a sentiment indicator, whether it's in Pepperstone's platform, whether it's online somewhere, you will be able to see that oftentimes the market will be going off in one direction and everyone else will be trying to go against it. And you'll find it just keeps piling higher and higher and higher. We've all been in that situation. Has anyone in the chat been in that situation? I'll put my hand up. I remember being like that. And we don't go with necessarily the greatest pulling power. When we're talking about scalping, these are some of the pairs that most people talk about. Things like gold, things like US dollar majors, major indices. In particular, when I'm talking scalping in today's concepts, I like to stick to gold versus the US dollar. These major pairs are very, very good. And I also like things like the S&P 500. They tend to work very well. The higher the liquidity, the better it's going to be for us. And the more retail traders that are involved in these markets, the better it is for this type of strategy. So that's very important to think about. Of course, which time frame is going to be best for you? Just a little bit of a tip. If you're trading the London session or if you're trading the US session, it's really open for a few different things. London session tends to be really great for currency traders. It tends to be an exceptional commodities time as well for great breakouts, for great liquidity traps like we'll be talking about today. And the US session tends to be incredible for indices and pretty much anything really coming into the US session. The Asian session tends to be a bit more gold and, of course, specific currencies that are around or indices around that particular time. Remember, that's the lowest level of volume that you usually see through the day. So therefore, it has the least amount of volatility, which has the least amount of traps, which means that, of course, for a scalper, theoretically, it is technically better to be around the London and US session. The good news is from pretty much everyone out there around the world, one of these sessions will be around at a point in time that you'll be looking at it. And of course, with the power of internet, Ty, and the way technology is, especially if you're using Pepperstone's TradingView platform, then you will have the ability to set alerts. And that's something that we will want to do. So I'm going to go through these sequences a few times today, but the powerful sequences in scalping is actually looking for the lower lows or the higher highs. And what I mean by that is waiting for the market to do something, and then you react to that movement. So as a market goes down, it's doing this. And we'll come back to why this is important for our supply demand later as we bring it all together. It makes a low, it makes a high, it makes a lower low, and then all of a sudden it makes a higher high, and oftentimes it will pull back and then slingshot away. This is a very common concept. It's what I call the first time frame change of trend. It has many names out there. Over here, we have a high, we have a low, we have a higher high, and we have a lower low. And you might look at this and say, well, Tom, that's just a few lines on the piece of paper here, and it doesn't mean much to me. Actually, what it is these higher highs and these lower lows are often representative of liquidity steals. So what happens is the stop losses that are underneath here get taken out for people that are trying to buy the dip. Remember, what are they doing? They're BTD. Well, sometimes they're BTFD type when they get really excited. But yeah, when that happens, we get that movement up, and then we get this final shakeout. It's effectively that shakeout. Have you ever been in a position? And I asked this to the chat. I want to know. And you get in the position. It's the right direction. You've BTD'd. You've decided I'm going to buy the dip, or you're selling the high, or whatever you're doing. Then all of a sudden, around the market open, it goes, nope, see ya. And then, bam, off in the direction that you thought it would go. You're left shaking your head, revenge trading all night, making all the wrong decisions in the book, going, what just happened? And unfortunately, this is the way it's designed to do it. It's designed to build liquidity and take positions out. So what you're better off doing around opens is instead looking for this to occur. Once you see it occur, hey, maybe then you're joining the banks. You kind of starting to probably see that concept or what we're talking about. Here's just an example again. We need it to make the higher high or the lower low. That's a very important concept with this strategy or this overall arc. So Ty, Wyckoff had a few laws, and you always know that I bring him up all the time because I see him as maybe like the forefather of supply demand in some ways. And I think you do too. And the reason why it's so important is because even though demand and supply is very easy concept, he came up with a great method, and that was the composite man, wasn't it? The composite man allowed us to understand that maybe the market is one entity, and simplifying life or simplifying trading actually is the true understanding of anything. I always find it that way. So they say that hockey puck concept, yeah? A great player looks at the hockey puck. An exceptionally great player, like the God mode, he looks at where the puck, or she looks where the puck is going to be in the future. And that's why that person is superior, because they're understanding it a little bit. They're still a very similar game, but at the same time, they're just looking that little bit ahead. So pretty much simplification is the most important thing, isn't it?
I mean, that's a really important point. I mean, I probably encourage everybody in the room to ask themselves, be truthful with yourself. How many times do you actually look at the market and see what you see right there, or where you think it's going to be in the next hour, 2 hours, or day? It's a very, very important point, because it is very much like a game of chess, where you do have to actually think a few steps ahead. Because if you don't, you can get caught up in that noise and that movement. And in hindsight, you're going to look back and say, "Oh, wow, I wish I had have seen that." And in truth, if you actually are thinking about it before you actually place a trade, you can actually train yourself to actually start looking for where you actually want the market to be and where you need it to be in order to place a trade, rather than actually be reactive to it.
So the 3 laws of Wyckoff, we'll go through the first one really quickly because we have a lot to go through. The first one is, of course, demand greater than supply, price rises. Fair enough. That makes sense. It's what happened pretty much the last 2 years to us, yeah? Now we're seeing demand is less than supply and price is hopefully going to drop, Ty. Hopefully inflation's coming down, yeah? So we can
That's
really...
what they said in Australia today. They said that.
Oh, did they?
The ships are rolling in, apparently.
Oh, the ships are... I did see the ships. I went fishing the other day. There were some ships coming in. So there you go. They're coming. Demand possibly is less than supply. And of course, we see this representative on the charts. And then we have demand equaling supply, no significant price change, and potentially lower volatility. Now, can anyone in the chat tell me, if demand equals supply, no significant price change, what do you think that might look like on a chart? Let me know in the chat. Mark also says, while we're going to the next slide here, I am guilty of buying the dip, being stopped out to the point, then the market takes off with my loss intact. Well, actually, they just took your liquidity as well, Mark. They were ultimately mean. They also took the other side. They were pretty happy with themselves, unfortunately. But look, I'll always say that was definitely me when I first started.
I think it's everybody. It's everybody.
Yeah, I think it's everyone. We can all...
Very rare cases where people avoid that, I think.
Yeah. So the 3 laws of Wyckoff were... The second law was the law of cause and effect. And I've said this a lot, but I just really want to drive it home. So Wyckoff's second law states that the difference between supply and demand are not random, and instead they came after periods of market preparation, okay? And when you think about it, these particular strategies that we're talking about, where we're making a low and a high and a lower low, what that actually is it's the fastest way for the market to prepare a position. That is to create the most amount of liquidity possible. I don't have a full way of explaining that today without, going nuts for about an hour and talking about it. But that is the fastest way for them to build a very quick position. In Wyckoff's terms, a period of accumulation, the cause, which can lead to an upward trend movement, which would be the effect, and vice versa for distribution. So basically, if we have, let's say, a market like this, then we have a cause, then we have an explosion out. That's the effect. Okay, so that's what it's trying to say. Now, a few people said here, consolidation. Niraj says ranging. Absolutely. Mahala says a channel. No Madness says sideways. It's perfect. Exactly. Look how we've got all these different terms, but they all actually mean the same thing. We all know what that is. It's just this. And I don't mind what you call it. I think people sometimes in technical analysis or anything like this, Ty, they get a little bit caught up in the wordings. And the most important thing is to understand the actual what the market's doing. So remember, Wyckoff was kind of saying, just quickly on that one, that this is the cause. What's probably happening in there once we see the explosion out? Well, the orders that were placed in here, so the big bank orders that were placed in here, they were most likely part of an accumulation that led to the markup phase. So that is the explosion out, the effect. So therefore, probably demand was actually outstripping supply in here. And if the market ever comes back down to this level in the future, there's a good chance that we probably will find some extra buyers. And you'll find out, again, why that will make sense soon. Let's get our heads off here so everyone can see this. The third law of Wyckoff was the law versus effort versus result. So Wyckoff's third law stated that changes in the instrument's price were a result of an effort generally represented by trading volume. That's interesting. Volume makes sense. So if we had like a stock like Tesla and it started to consolidate, it's like this, with a very high volume after a big drop, that could suggest transactions were high and a reversal could be near. Now, we're not going to use this one today, but think about it. If the market's going down, let's say we had a whole bunch of candles coming down, and then all of a sudden it goes sideways, and the volume remains the same throughout the down and the sideways. If you're a stock trader as well on the Pepperstone platform, you would know that that could show us a clear sign of people getting involved. And that could be the composite man getting involved. So then he came up with these final and I think most important concept, which was the composite man. Let's simplify the market. Let's basically say it's us versus them. That's what it is. Wyckoff created the idea that traders and investors should consider that the market was being controlled by a single entity, and that single entity, being the composite man, represented the biggest players, the market makers, the hedge funds, Wall Street, whatever you want to call it. And it allowed the algorithms, which is pretty much what you're looking for nowadays, the algorithms. And it allows a trader to better understand how potential market manipulation manifests in price action. So if we, again, are seeing a channel, and the current way you look at it is it breaks out, and you say, oh, I want to be in the breakout. Well, yeah, I mean, you could do that. But what happens if we get into a breakout and it's a false breakout and goes off like this? Well, then we get trapped. I don't like being trapped, Ty. Trapping is bad. I want to be the trappee. I want to join with the trappers or whatever in the forest. So that's what we need to do. So
what set the trap, not land in them.
Well, yeah, or join the trap of the algorithm. That would be the best. So if the market then breaks out and we have that effect, again, we could say that if the market comes back to this level, something happened here. Demand outstripped supply. The market reacted off that. We can then clearly state that if the market comes back to this zone, we might be interested. And this will make sense when we look at the scalping side, some examples very, very soon. So again, it doesn't matter what time frame this is. I don't care whether it's a 5 minute, a 1 hour, a daily, a weekly, a monthly. It's probably a little bit higher, but it doesn't matter what time frame it is. It's the same concept. Here is effectively a demand equals supply consolidation, sideways, whatever you want to call it. Then we see demand outstripping supply, and we get that upswing or that markup. Then we see supply outstripping demand, and we see a downward swing, and demand outstripping supply and upward swing. That's really supply and demand in a nutshell. But let's understand why this is important and why they form. So changes in supply and demand only happen when big traders buy or sell. When price falls, supply will outweigh demand, and vice versa, of course. Retail traders are, in essence, this is us, unfortunately, we're small fish. And we won't generally make prices rise or fall. Now, you could argue with Tyrone and I on this one if you wish to and say, but Tom, Ty, GME, AMC, 2021, that was retail traders. Yeah, unique circumstance. But in general, I don't think retail traders move the euro US dollar.
Yeah,
I think
those stocks got documentaries made on them, but I can assure you, you're not going to get a documentary made on yourself because you've moved the market. It's not going to happen.
That'd be cool. Make sure
you call when
that happens, by the way.
Yeah.
So that would be nice, though. Yeah. So basically, in forex, commodities, stock markets, indices, big banks, and institutions can never, and this just makes perfect sense as soon as you hear it, can never place their full positions all at once. Of course, they have to place them over time. They instead need to push price around to get enough liquidity to enter their positions over several thousands of transactions. So in essence, if we think about it, a big bank or an institution, in this case, we're going to call them the composite man, they need to additionally add to their position. So let's say we have a drop, then we see this, then we see a market go down, and then the market starts coming back up, and then it hits this area again. What can we assume happened here? Probably some orders were placed into the system by algorithms, by the composite man, by others. And what happened was the market reacted to that. It dropped heavily. So when it comes back to this zone in the future, as we know orders were placed here, and this was in essence supply because the market, of course, went down, there's a good potential that this will be reacted to on the smaller timeframes. And this is something that you always want to be thinking about in markets, that there will be reactions to these things. Here's an example of a live chart. The banks or instos or composite man or whatever you want to call it, places sell positions and the price ends up falling. This is retail traders. Buy the dip, buy the bit, everybody. We got to get in, buy the dip. It goes up. It looks pretty good. Or it's a bit scary. Or it looks pretty good. Oh, wow, you're taking the stop losses. Whoops. And then it pushes down. I don't really want to be part of that. What instead I want to be part of is when I know that this order area has been reacted to because the market has already pushed down. Remember, that's the effect component of what Wyckoff was telling us. Then when it comes back here, price returns to potentially grab liquidity. The big banks haven't placed enough of their position. They're greedy. They want to be in, just like all of us want to have our positions, except that we trade minute contracts or thousands of dollars, don't we, Ty? How big do they trade?
Oh, they're huge. And I think it's probably, even though you're renowned as being a small fish, it's not a bad thing because it means that you can swim amongst all the little rocks at the bottom of the ocean and not get eaten by the sharks. Being a small fish allows you to be agile. And agility gives you the opportunity because you aren't trading. They've got a massive, massive disadvantage because they have to actually set these things up to actually get their trades in. Whereas we can actually get in a lot quicker, a lot more agile, and actually be a far more, I guess, taking a far more advantage of these moves rather than have to really, preempt where it's going to go. We can preempt where it's going to go and trade it rather than actually build positions. It's a big advantage. Don't be afraid of being a small fish.
Yeah, so here's a great question coming in from MTT, and it says, do the big banks actually scalp? I thought only retail traders do. Well, the big banks will use an algorithm to scalp. So you're correct. Retail traders are really the ones that are scalping. But what you're trying to do when you're scalping is, in essence, if you use a higher time frame to look at where the orders are, we want to join the algorithms as they place those extra positions, effectively grabbing the liquidity that they require in those markets. So that's what it's about. It's about that. Here are some methods that people often look at. And this is basically the Wyckoff method. Wyckoff said accumulation, markup, distribution, markdown. That was what he said the market was made up of. Here's another concept, Dow theory. We have accumulation into public participation, into an excess blow-off phase, into distribution, into down. You can see they're very similar, very similar concepts. And then we have Wyckoff schematic, which I'm not going into today, but if you wish to, we can all check this on Pepperstone's channel. So we can definitely go and have a look at some of the old videos that Tyrone and I have done on this concept. There's one of the schematics and the way that markets slowly build a position. But as a scalper or day trader, I'm not interested in slowly building a position. That's not really the play. This could take a little while to play out. So instead, what we need to do is we need to say, okay, can we find levels that may be reacted to? And if they are reacted to, can we then scalp in those areas? And this is where we create the box zones. So you'll notice over here, we have a ranging market. The market then explodes out. And most retail traders are going to say, I wish I was on that. I'm feeling FOMO. Why am I not in? Oh, I'm in. And then it goes the opposite way against you. That's what you don't want to do. What instead we do is we say, oh, cool, that was a nice reaction. I'm going to now box this zone so that in the future, should it come down here, I might want to try scalping up. Because what happened here? Well, we know that demand outstripped supply. The reaction was incredibly aggressive, and we saw a huge market pick up. So that means that if it comes back to this area in the future, there could be a reaction off that. And that reaction is what we're trying to get as a scalper or day trader. We want that to usually happen around opens. And we've got some examples here today in the charts that happened just recently that we can look at. So we have the supplies, which are the top ends here, and we have the demands. Now, I'm not going to go into this because we don't have enough time to go through it all, Ty. There's so much information here. But basically, here is just a little bit of a write down on supply zones. Think of supply zones as where the composite man or the banks and institutions have placed significant numbers of sell positions. And as the banks and institutions place their orders, they create excess supply, and the result is price reversing and moving lower. So they get excited, they start placing, they all join on, they're like, woo! And then they're like, oh, whoops, we've pushed it too low. In fact, they want to sell up here, and then they allow the market to go back up into these areas, and then they get back in and they push it. So that's supplies. There's some examples, and then we get demands, and there are some examples. So I'll put it back here just so you can quickly look at it. Demand represents where banks and institutions have placed significant numbers of buy positions. And then as the excess demand goes out, it explodes. And of course, we then want to be boxing this in the future should the market come back into it. And that's in the essence of what this all is. Yes, Tyrone?
Yeah, look, as much as we're small fish, we still want to actually be moving with the big fish. And I think this is what it's really all about. Like the best way you can look at it is if you're a small fish in a big ocean, is it going to be harder to make your way long distances by yourself, or do you want to catch a ride on some of those big whale sharks? You see those documentaries, the big whale sharks with all those little fish attaching themselves to them. It's a little bit like what we're explaining here. You're actually waiting to jump on board with the big whale shark and actually get not effectively a free ride, but a lot easier ride. You're gonna be able to travel a lot better on the whale shark than you are on your own.
I would travel with the whale shark, Ty.
I'd travel with the whale shark too.
Yeah. I don't want to be with the tiny ones. Yeah, I'm not going to be with the krill.
No.
No krill. All right, so let's have a look at the example here. And this is just a little example I've taken from the odd. And this is a 5-minute chart. So, hey, you can do it on any time frame you feel like. The essence here, though, is I've loaded a few things together. So the first one is I want to know when the sessions are open. Now, this is actually set a little bit wrong. But in TradingView, you can load indicators and you can load up sessions. And you'll see there's all these beautiful created indicators. You pick the one you play around with it to your time frames and everything else. But what you might notice is that there is an area here. Can we all see that area? Here's a little block zone. And this block was reacted to. Now I'm going to make it green because I like to make my demands green. And I gave away a question I was going to ask everybody. But do you notice that the market explodes? It goes, whoa, right up over some other sessions ago. Then all of a sudden, during the Asian session after New York, we start to consolidate. So this blue area is the consolidation. And then it consolidates. And then at the end of the Asian session, it gets weaker. And then all of a sudden it starts to come up. And then just before the London Open, it takes the low and swings. And if you notice, this all happens at that previous little area over here, which we knew was demand because the market broke out. So therefore, demand outstripped supply. So it would be a good area for us to have our charts ready for the day. Now, it just so happens that it makes a new low and swipes all of the poor little people that are trying to buy here and takes their low. And then you get this giant wick. And what's a wick telling us? I'm going to ask the chat here. What do you think a wick's telling us about the market? Let's see if anybody in the chat has an opinion on this. This big 5-minute wick. And again, this just happened before and happened during the London Open. And you can see it happened during the London Open because we get that huge volume increase starting to come through. Look at the Asian session. Decline, decline, decline volume. Frankfurt, Europe, London, spiky, moves up. All right, let's read the chat here. Moses says, great stuff, guys. Awesome. Thank you very much, Moses. Glad you're enjoying it. And Victor Young says, I had it yesterday. I think that's in regards to one of the traps, Ty. He wanted to join the whale shark, but unfortunately, he got krilled. Simon Wong says, hi, what time frame you use for supply demand zone? Theoretically, you can use a lot of different time frames. There are, of course, the higher up you are and the better and the bigger the time frame you're using, technically, the better the orders will be. But you can see here, we're just using a 5-minute chart for this example today. And Yinzhang Wang says that's a stop loss hunt. Yeah, absolutely. Trying to get liquidity, rejection, limit orders from Alham, grabbing liquidity. Yeah, look, again, you can call it all of those types of things. But what a wick also shows us is it shows us incredible demand. So a wick will show instant wick rejection. It's much more than just a wick. Everyone looks at this and they learn it as the first candle. I think it's the first candle, Ty, that everyone learns. The pin bar, the hammer. I don't know.
Shooting star.
The shooting star, the rejection version of it. Yeah, there's other names. I know pin bar's one. There's some fakey thing someone said. I don't know. There's a whole bunch.
Single tweezer.
The single tweezer, is that one? I don't even know about the single tweezer. There you go. But yeah, I do love double tweezers, by the way. Double tweezer is pretty good. It's a proper tweezer, that is. What a wick is telling us is a wick is saying that inside of that particular period in time, being the 5 minute here, there was an incredible algorithmic change. We've got to, let's be real. There's algorithms all over these markets. Yeah. We know that by the day, more gets stacked on top. Einstein's out there are coding these things. Probably smarter. Well, they're definitely smarter than me. Tyrone, are they smarter than you? I'm not sure. Are they smarter than you? The Einsteins? No. Are you smarter than the Einsteins? All right. Well, I'll put my hand up. I'll say the Einsteins are smarter than me. And they're coding these robots. And what we want to be looking for is when they get excited about a position. And often that will happen through wicks. So you see this low getting taken, then all of a sudden in the zone box, it just goes boom. And that shows us, wow, there's some real momentum behind this. Something just happened. There was a shift. And you'll notice I say patience here, react, don't predict. Hey, I'm not predicting anything. I know this zone's pretty cool. I'm excited about it. But when I see something like that coming into the open, damn, that's nice. That's a hunt. That's exactly what you want to see coming into an open. And then, of course, that ends up fronting a quite nice run that's happening at the time of this recording. And you can see here the odd is, bulleting off at the moment up until these areas. And just so happens, of course, these areas would be good take profit zones. Why? Because they were previous supply that then was reacted off. So if I was looking at this today, around that area would be a very fair profit for a take profit for Scalp. And this is going, of course, through that London session. So you might think, well, okay, cool. You cherry picked that. Well, let's have a look at the previous session. Now, I'm not sure if this actually has a previous big demand in it, but it turns out it does have some demand over here. And look at this. Here it is. And look at that market. See how that market just goes, wow. I mean, that's a move. Damn, I'm excited about that. That's a huge move. So the market comes down and you'll see again, it swipes that low and then it reacts off it. And this tends to be something that is common within market conditions. So today we've learned about one thing here, and that is that around session opens, swipes tend to occur. That is, they'll make higher highs or lower lows, and often they'll be at critical points ahead of those market opens. That allows then the algorithms, that allows the bigger traders to get involved in it, and then they get that liquidity, that initial injection, and then they push it in the opposite direction. Ideally then getting a whole bunch of retail traders to go, oh, I want to short here. And you can see they tried and then they crushed them and they squeeze. Now, are we all familiar in the chat with the idea of squeezing positions? Like squeezing the orange juice in the morning? I haven't done that in a long time, Ty. Okay, so basically what squeezing is it's when the effectively retail traders or other traders get into short positions, and it's in the best interests of the market because it's in that markup phase to then push higher to liquidate those short positions into longs, which they have to buy at a higher price. Now, people think that this is a new thing because in 2021, everyone got exposed with, of course, what was going on with AMC and GME and all of those stocks. However, squeezing is happening on all time frames and just different. We just don't see necessarily the orders that are there. But I can assure you that unfortunately, some retail traders are trying to short this position. And as they're shorting it, especially more and more pile on, they're getting pushed out. Now, I'm not saying you're going to go and get into a position like this and it's going all the way to the sun. It probably isn't. But what it will do is it will move into these style of areas. And these are going to be good take profit zones and areas that you can be saying, okay, cool, that's where I want to take those profits. Other supplies or other demands. And that usually most supplies and demands, Ty, they have reactions to them, don't they?
Yeah, they do. They do. And I think when you're aware of the levels that you need to get to, I mean, yes, you've got to be aware of the squeeze. I mean, Thomas hasn't squeezed orange juice in a long, long time because that's what his maid does now. But yeah, you still have to be aware of them, even though you don't need to be part of them, obviously, but you need to be aware of them. And I think a lot of these zones do create that situation. And I think it's a little bit like what we were saying before, being aware, having and trading with your eyes open, knowing what can be happening in a particular zone is the most important thing. Like we said, look, there are a million different candle patterns and candlesticks that you can label, but one of the most important is the wick candle. Yeah, call it whatever you want. It doesn't matter. It's the price action that we're talking about, and understanding that price action and knowing what is likely to happen and what it represents is probably the most important thing. Is really understanding a lot more about the market than you probably realize.
It is. Look, I'm still sometimes surprised that I've looked, as have you, Ty, at ridiculous amounts of hours on charts. Like we've been doing this quite a long time. I mean, I can't believe it's probably been 14, 15 years for me.
Coming on 15 years.
So I mean that means I'm 35 today. So that I've been doing it since I'm technically still 16. So but realistically since I was 20. So it's amazing how many hours we've put in, but I still think that there's simplification to be had in every concept. And I'm always surprised hearing things from you, the community members out here at Pepperstone, and for everyone else. Everyone has a great opinion on things, and just having a chat with a lot of you recently at a conference we did, it was surprising. I just pick up things. Like I hear something, and go, that's a simplification of that. And you're always striving to be better. So remember that we're always striving to be better on these trading positions as well. So here's just an example I wanted to show of a higher time frame than doing a very, very similar thing. And this is the US dollar index. And you may notice that we have this significant previous demand zone that was clearly reacted to, because you can see it was here and led to an incredible rally. Now the market's come back down and it's reacted in this area, and we found buyers. But something happened this week that's pretty interesting. At the time of this recording, it's fairly interesting. And that was that we had a low here. We obviously had a high. We had this swipe that occurred, and then it just went bam, straight up. And this is on a 2 hour, and this is coming into that demand zone. So even if we go down to really small time frames, as it enters into these positionals, we're looking around opens. We're looking for things. We're looking for these sequences to occur to show us. Because you'll notice here, see how while it's going down, it's pretty much, especially when it makes these new lows, it's not going to a new higher high. It's just kind of, continuously weakening. When it does switch, that's a fairly significant change. And that leads to a massive pump that happens through here. A new lower low was formed, and it gets very, very aggressive. If you have a look at the daily close on this then, and a lot of people don't look at these daily closes enough, Ty, and you look at this and you go, wow, that's a big wick. Wow, that's a big wick. Maybe in the next session, if it pulls back, I should be more towards the bullish side. And that's just that's the second thing I think Tyrone and I wanted to talk about today, which is that, yes, we're talking about supply and demand and identifying these blocks or orders in the system. That's going to be important for scalpers out there. If you're a scalper or a day trader, it's essential that we do that type of thing. But also, Tyrone hit the nail on the head when he said wicks are much more than what you just think of. You just look at it and you go, oh, that's wick. Well, what if there are wicks around these demand zones or supply zones? What that's telling you is that potentially the algorithms are building a position that could explode. And when you see these wicks, if the market starts pulling back the next day into the session opens, London or New York, Ty, what are we trying to do then?
Yeah, absolutely. We're going to react to that zone. And that's the thing. It's probably another point that we didn't really touch on, that wicks are very, very important. But like all candles, they have to be in the correct area. Wicks in the middle of nowhere don't represent the same thing as wicks at a supply zone or a previous tested zone that we're talking about. So when you are identifying the correct zone and also the correct time frame to trade it, like a market open or something like that, they're going to be far more significant than in the middle of nowhere with no friends, basically just making up what we call market noise. So as much as they are important, it's very, very important to identify them in the correct zones. Okay, applying the correct zone and the correct time frame to actually trade it. So when I say time frame, I mean at a market open particularly, and that's when they are very, very reactive. But a wick in the middle of nowhere is not really worth anywhere near the significance of the areas that we're talking about here.
Just as I need to remember this, Ty, I better put in just a quick risk disclaimer. We'll be right back in 1 sec. Now, that's not in regards to Tyrone's comments. It's just at the start.
Yeah. So trade every wick you see.
Oh, now the risk disclaimer's done. Yeah. So anyway, so we're looking at these wicks and we're looking at the dollar index. We've got some questions coming in here, but yes, we always want to be. Tyrone says, look at the wicks at the key areas. So important. I'm going to show you gold. Now, you're not interested in this, probably most people here, but this is the weekly gold wicks that we had. And if anyone out here does also watch our channel, you'd know I was ranting about these over the last month and talking about how there was an incredible amount of wicks coming through here. And you can see that that's a very powerful, and then it led to a crazy move, a very large move. So these wicks showed us something. They told us that the market was really paying attention to this level and building a position. And on the smaller time frames, that's important. So we got a question before, what time frame is best? Hey, I like looking monthly, weekly, daily, 4 hour, 2 hour, 1 hour, 15 minute, 5 minute, 1 minute scalp. Now you might think, wow, that sounds insane. But actually what you're doing is you have a clearer picture of what the big banks are doing. You can see what they're doing on the timeframes and where, more importantly, they're probably building their bigger positions so you don't get caught out in the wrong thing. I would say almost like the biggest mistake I see most traders making, there's two big mistakes. One is that people trade dollar risk and fixed risk, Ty. So they say, I'm going to risk every time 2 contracts. And then they have different stop losses, or they say, I'm only going to have a 20 pip or 20 cent stop loss or whatever. That's a huge mistake. You should be looking at percentages and being market adaptive. Absolutely. I know, because again, I used to do that. So I've been there. I've done it. I know what it's like on that one. So does Tyrone. I still remember our spreadsheets, Ty. They were wild. So anyway, the other one is that a lot of people, they don't practice, I guess, their consistency and their psychology as well. And that is that they have to remain replicable in their systems. And that is constantly following the same types of system and try to replicate it and build it like a business. So that's something that we want to do. Now, I bring these up because Robbie says here, hi, Tom and Ty, would you take 2 minutes to talk about the psychology of traders who have had losses after losses and how to come back strong and focus on logic and not emotion and setups and not revenge? Yeah, it's a very difficult one, Robbie. It really depends on how bad that pain is from the loss. And look, we've dealt with a lot of people, and over that time, the problem is you do have to let it go. And look, I'm sorry if that's happened to you or anyone else there that's happened to, but the key is to understand that actually success comes from compounding. And although it may seem really painful, generally in those situations, you have to pull right back to doing very small risk trades and get your consistency up. And then know that if you do get consistent, that you can then compound it out. And Ty, you made a great program on our website, fxevolution.com, about this, didn't you, with the Pressing Account Builder?
Yeah, the Pressing Account Builder really helps navigate you through that, Robbie. I'm not sure if you've done it or not, but you really should have a look at that because it really gives you the confidence in your system. I think revenge trading comes from a place where you don't have confidence in your system, and you don't want to admit it at the time, and you'll never actually allow for that to enter your mindset. But in reality, that's what you're actually doing, because if you believed in your system, you wouldn't revenge trade. It's as actually simple as that. And you would take the losses as they come and know that your system is strong enough to overcome this period. And yes, you can adjust your risk and make it a little bit lower and work through it. But you can only do that when you've actually got the confidence in your system. And the Pressing Account Builder and it basically forces you to do that. And it's a free program on our website. So you can certainly check it out because it will it'll go a long way to actually dispelling a lot of the problems that you're actually talking about there, Robbie.
Yeah, you've got to just realize that if you do get it consistent, you can compound that up, and that will work out for you, hopefully. So let's just quickly check this out. I just wanted to highlight this supply here on gold. This is a 2-hour time frame, but what it allows us to do is we can say, okay, we know that this was reacted off. It's clear that this was a pretty good supply. And look, there is a talent, Tyrone in here. I am not here to say that it's so easy to find some good supply and demands. There are ways and means to do it. Yes, that will take a little bit of time for you to understand. But what I guess the essence of today's session was to say, these things are where orders lie. And you can see how the market's reacted off those. This was the supply. The market is building a short position. At the time of this recording, it's come back to this level again. Now, ideally, with building positions and supplies, you actually want them to have these really quick reactions where they build a quick move and then they sell off. And this is where scalpers come in and they look for their activations within these zones. So whether you know the activation that we use for it or whether you have your own activation for scalps, why not consider, rather than just support resistance, why not consider finding those supply and demand areas where orders lie on 2 hours, 1 hour charts, 15 minutes. And if then the market's coming into those around session opens, you have an activation method. Do you think that stacking where orders clearly were and reacted to in the past with your activation steps, you won't have a better system? I would argue you most likely will, because you're building a confluence of steps, aren't you, Ty?
100%. And one of the biggest advantages of actually trading with this method is the risk versus the reward. One thing about knowing where the zone is giving you really, really big risk reward. All the examples that we've shown you today, you can see how the market explodes out. Now, when you're setting up a trade like that in an area that you understand, your stop losses don't have to be that big, because you already know that that level is going to be, a very reactive level, and you're going to get that short and sharp move. But you're generally, attacking trades that may be 4-1, 5-1, even up to 10-1 very, very quickly, because you've got very, very tight stop losses in terms of where you're putting them versus where the market has actually been, because you understand the zone. You don't need a massive stop loss and put it behind the last massive swing, because you understand that zone is going to have a reaction. And guess what? If it doesn't, it'll take your stop loss out and you're done with it. It doesn't matter. Not every single trade's going to work out, but by golly, when they do, they're going to be big payoffs and they're going to be fairly consistent. And that's really what you're after.
Yep, that's what we need. I want to take a few questions here. The two stories, or the two things that I wanted to really mention today, was find orders, supply, demand, reactions off those. And then, of course, think about wicks a little bit more differently. So that the way that most people trade these things is they look for, I guess, just candles. I like to look for wicks. So that's why I highlighted this little area down here. You'll notice it takes the low and then instantly rejects. And what that's telling you when it instantly rejects back up above here, that this is probably going to become a double bottom, which a lot of you will know, that the level down here has taken, no doubt, shorts, and it is going to squeeze them. And see the reaction to that, very aggressive. And then it goes up here to our supply and it reacts off there, and et cetera, et cetera. So these are where you want to drive into those small time frames for your opens, for your 1 minute, 5 minute charts. So with the questions here, Ty, system account builder, it's called the Presic account builder, Halia 1 over at fxevolution.com. Again, it's free for you to get. So if you'd like to get that, it's just a compounding style system. Alham says here, one time frame is like having a tight shoe. Yeah, good point. Absolutely. And No Madness says, hi guys, love the webinar. What do you mean by percentage trading? So what we mean by that is that when you think about your account, let's say your account is $10,000. Most of you will think about it as a dollar amount. You'll say, I'm risking $100 per trade, or I'm risking $200 per trade, when instead we should just be talking about percentages. And what this does is it helps strengthen our mental state, doesn't it, Ty?
It does. And absolutely it does. And that's what gives you the confidence. When you know what you're doing, you don't need to take big risk. And you're not going to go, slitting your wrists over a loss because you're doing the right things. When those percentages have a zero behind them, as in 10% and 20% of an account, like some people do, that is dire. And it doesn't matter how good a trader you are. I mean, don't think for a second, that Thomas and I, who have been doing this for 15 years, are ever placing 10 or 15% trades, even if we are absolutely certain of a direction, because you can never be absolutely certain of anything. But what you can do is put obviously all of the I guess all of the advantages in your favor. But even when they are completely lined up, we still do not risk more than a normal risk, because that's when Murphy's Law kicks in, and it will completely hurt you in a way that, you know, you don't want to be hurt. I don't like being hurt, and yeah, we don't want you to get hurt either. That's what the percentages are all about. Yeah. So no, most definitely. We've got a question there about, is there an indicator that shows these areas? Look, there are varied indicators, but nothing beats the human eye to understand the level. Are there algorithms that are potentially in place to actually take advantage of these? If there are, we're certainly not running them, and that's probably where the big banks algorithms actually are. But they're far more sophisticated than, and believe me when I say, and I can tell you this with a great degree of confidence, if they are there, they're not for sale, and don't think you're going to buy one. So just be very, very mindful of that. Okay. If there's the promise of an indicator that does those sorts of things, I would be taking a very, very solid test of it first before paying and outlaying any money, and being very, very confident. But if there is a good one yet, well, we certainly haven't seen it, have we, Tom? And more than likely, if there are, they're not going to be available to the public for any price.
Yeah, it'd be very hard to code actually to see the sideways. What you're looking for though is like what Wyckoff said, which was basically demand and supply are effectively equal, and you get that consolidation. So really, it's more about looking for consolidations. There are other ways of doing it that are pretty important, but yeah, that's what we would look for and do. So yeah, in essence, we just like to kind of finish up here, and I will answer the next couple of questions. Of course, don't FOMO. I always like this one from years ago, which is, I think it's got the old logo actually on it, but that is, don't take too much, risk or anything like that, and don't be too scared about things. If you're interested in this type of strategy or this type of way of thinking about stuff, then of course you're welcome to come on over to FX Evolution. You can use code Pepperstone Scalping 25 to get a special offer on the FX Evolution Scalping Masterclass. And what it's all about is pinpointing scalping and day trading methods that get you 4-to-1 to 10-to-1 risk reward strategies. So that is, if you're risking $100, ideally you're making $400 from these types of trades. And the reason is because you're stacking that confluence in your favor. Now, let's answer these questions here, Ty, that are coming in. Robbie says, last question, CPI today was good. China may ease down. That is, lockdowns may be eased. Will this be good for the ASX 200 like bullish? Look, I don't really look too much into those bits of news, because as we know, most bits of news don't have a strong effect on markets over more than a couple of days or even a couple of hours. There's no doubt that inflation's the number one number. And that's a CPI number that comes out from somewhere else. We want to know what's happening with America's inflation number the most.
Yeah.
China may ease down as speculation. We don't know that. And at the moment, we are at critical resistance on the S&P 500. So we are within what, a percentile of that trend line.
Yeah, no doubt. America leads the way, and so much so that it'll bring me to our next point. But at that CPI number will make no difference whatsoever if the US sells off heavily tonight, or something should happen and they see a percent drop or a 2% drop. Make no mistake, we'll be following tomorrow. So you've really got to compare economies with economies. But at the end of the day, if you are trading the ASX, we are still very much governed by what's happening in the US. The major indices, the Russell 2000, the S&P 500, of course, and to a lesser extent the NAS, but the NAS does what the other two big ones do anyway. Really, we're governed by what they are. So it's very, very important to not only do multi-time frame analysis when you're trading the ASX, but also doing the comparative analysis as well, and what's happening on the world indices, because they, whether we like it or not, do dictate where we're going. It's very, very rare that we decouple from those indices for a long extended period of time. And I dare say that we're not going to be decoupling at a time when inflation is at its highest. We're looking for all of the advantages from what's happening in the US. If our inflation goes down, but the US is still going up, our market is still going to feel the pain. That's just simply how it is.
So Yinzang says here, have you guys implemented bots in supply, demand, or trade manually? You can implement bots if you want to, but really you're implementing generally alert triggers. Alert triggers are usually the best way of doing it. Look, there is some nuance to anything. We create replicable systems, and the replication is key. But I like to set alerts. Bots can be helpful as assistants. The problem with bots is if you actually think about it, when you run a bot, markets conditions slightly change. That bot has to be constantly updated to the current market conditions, volatility index, VIX, movements in markets, consolidation ranges, shutdowns. Ty, how much effort goes into constantly keeping it up to date with movements? You're a bit of a robot expert on that stuff. You may have frozen. Well, I'll answer the question, and that is it's a lot. You have to constantly optimize it, and it takes ages, and I'm not a big fan of that. So, yeah, look, we've done a lot of robot work. A lot of people get into markets and they think, are we going to algorithm it? The problem with that's always going to be, can you do it better than the Einstein out there that's doing it? And in general, it's very tough and very time consuming. I'd rather focus on being able to better read the market traps and then following those traps. That's the best way to do things, at least in my opinion. Robbie says, thank you. No worries. He says, happy birthday, Tom. Once again, 35 is so young and you're already super successful. Oh, I'll try. We try to be. Obviously, the main thing is that it's still hard work as well. So this is, there's no secret that trading is damn hard. Okay. And if you want to be a scalper or a day trader, you have to create replication. And it's very important. If you don't do that, then it's just going to be incredibly difficult for you to build a business or system. So just remember, business is how trading needs to be. It's not necessarily a cowboy land of fun and games and running around, trying to lasso bulls. Instead, it's actually quite difficult, and you have to be disciplined. And I'm going to give you all a word to end today's show, and that is temperament. So temperament is so important in trading. You have to almost lose your emotion in terms of your bias emotion, your ability to, feel like, kind of fear or greed. Instead, you have to become kind of like neutralized. And I talk about that a lot in the courses that we do. And Tyrone and I mention all the time, because when you're neutralized, you don't really have too much of a bias either way. So when the market shows you a direction, you don't have fear or greed. You just take the direction that it's showing you. So we'll go with temperament for the end today.
I'm going to go with another word, and that word is US dollar, Thomas. And the reason I say US dollar is because as of the 1st of December, we are moving to the US dollar-based currency. And the reason for that is we are obviously not just an Australian company, we're an international company now, and our website is actually moving to US dollars. So if you are interested in any of the courses that we've talked about, or the scalping course in particular, which is what tonight was based on, now would be a very, very good time to buy it, because as we all know, the US dollar is considerably higher than the Australian dollar, and that is literally changing at midnight New York tomorrow on our website. So if you are interested, there has never been a better time to actually lock in probably all the best prices ever going to be at, because it's a very, very important course. And Thomas Free's birthday wanted a US dollar-based website, and by golly, we're giving it to him.
Okay. I do like US dollars, Ty. They are the best. I'm sorry for all other Australians out there or other countries. USD is the best currency in the world.
And look, it is, and you know what? So much so that every country basically pays in it, and that's why, we've had to move to that model. But look, it is a great course. Thank you so much for joining us tonight. Though hopefully you did learn plenty. Watch it again if you need to. It's a lot to take in. We understand that, but definitely watch it again. You can just press the same link. And that should start it again for you. Watch as many times as you need to. And if you have any more questions about it, just certainly send an email to your Pepperstone representative. And don't forget to always tell them what you're interested in learning, because we always want to bring the presentations to what you really are interested in and what you want to see. So please give the feedback and let them know what you would like to see, and they will pass it on to us, and we'll bring you the best content we can.
Absolutely. Thank you so much from both Tyrone and myself. We'll see you in a few weeks' time for another one of these live sessions. Always great to see each and every one of you out there. Best of luck in these markets. And do remember, this Friday is jobs numbers in the US. That is non-farm payrolls. It's widely considered one of the nastier events, where often markets will go off in one direction and then the opposite direction straight after. That is because it is often a liquidity grab. So be careful around those times if you're a scalper or day trader and you haven't seen enough and you haven't done enough work around them. For people that are in the know, they can sometimes give you great opportunity as well. But you need to be careful. All right, stay tuned for next time. We'll see you then. Bye for now.
Thanks, everyone.